The New Jersey real estate situation in 2026 isn't collapsing all at once across the entire state. Instead, it feels more like a gradual pressure change spreading through areas that were once assumed to be stable and protected. Commuter-heavy regions, beachside communities, densely packed urban centers, and older industrial cities are all part of this shift. These are the kinds of places where buyers once justified stretching their budgets because they believed the location, limited supply, or strong reputation would always carry property values. That belief is exactly why the current moment is so important. New Jersey was never marketed as the affordable choice. It was always about compromise. You paid more, but you gained easier commuting options. You paid more, but you got access to strong school systems. You paid more, and in return you lived closer to major job hubs and everyday conveniences. For many years, that trade-off made sense to buyers. But by 2026, that same logic is becoming much harder to justify. Across the state, homes are staying on the market longer, buyer interest is cooling, and sellers are increasingly realizing that the prices they were aiming for belong to a different market cycle, not the current one. On the surface, statewide numbers still look relatively stable, enough to give a false sense of security at first glance. In February 2026, New Jersey home prices were up 3.8% year over year, with a median sale price of roughly $540,400. However, at the same time, total home sales dropped by 11.1%, and the median time on market increased to about 60 days. That combination doesn't really reflect steady growth. It signals a market that is beginning to split in different directions. Some areas are still holding firm, while others are already showing signs of weakening beneath the surface. And once that kind of divide appears, statewide averages start to hide more than they reveal. This is Discover the Cities. If you're interested in housing insights that go beyond surface-level listings and actually show where pressure is building, make sure to subscribe. Today, we're breaking down 10 New Jersey cities where the housing market is beginning to show real cracks. Number 10. Hackensack is where this countdown begins, and it stands out because it still looks solid on the surface while feeling noticeably weaker underneath. It's one of those Bergen County markets that buyers are typically encouraged to trust without hesitation. The city has density, strong regional access, a recognizable North Jersey reputation, and the kind of everyday convenience that usually keeps demand steady. It was never positioned as a low-cost area, but it always sold a very practical idea. You were paying for location, ease of commuting, and the sense that the housing market here would remain reliably stable. For a long time, that narrative worked. That's exactly why what's happening in 2026 is so important. In February 2026, Redfin data shows Hackensack home prices rising about 7% year over year, with a median sale price near $420,000. On the surface, that still seems relatively healthy. But the deeper story is different. Homes are now taking roughly 91 days to sell, which is a long stretch for a North Jersey market that's supposed to move with consistent demand. When you zoom into zip code 07601, the contrast becomes even clearer. The median price per square foot dropped 4.9% year over year, even while overall median sale prices increased. That kind of split usually signals that the headline numbers are being supported by weaker underlying value trends. And that detail matters because a city like Hackensack doesn't need a dramatic crash to lose momentum. It only needs buyer urgency to fade. Once listings start sitting for this long, the assumption that North Jersey demand is automatic begins to break down. Sellers stop getting quick offers that validate their pricing. Buyers, in turn, become more selective, take more time, and start treating asking prices as negotiable rather than fixed targets. That's typically how a market like this begins to soften, not through an obvious collapse, but through slower movement, quieter confidence, and a shift where sellers can no longer assume the next buyer will simply step in and meet their number. In 2026, Hackensack is showing how a practical North Jersey market can gradually lose strength, even while the surface-level data still makes it appear stable. Number 9. Elizabeth lands at number 9 because it's one of the clearest cases of a market that still has activity, but not the same level of underlying support it once relied on. This is a city built around connectivity, port infrastructure, proximity to major airports, highway access, rail lines, and direct ties into the broader regional economy. That kind of positioning made Elizabeth easy to justify in stronger housing years. It was never seen as flashy or luxurious, but it consistently offered practical value. Buyers who were priced out of more expensive parts of the state often turned here because it still felt like a reasonable way to get access, even if it came with trade-offs. That practicality was always the core selling point. And when that sense of practicality starts to weaken, the overall tone of the market shifts with it. Looking at the data, Redfin reports that in February 2026, Elizabeth's median sale price sits around $665,000, which is up about 2.3% year over year. On the surface, that still looks like mild growth. But the deeper indicators tell a very different story. The median price per square foot dropped sharply, down 61% year over year, suggesting that the strength behind the headline price is not holding evenly across the market. When you break it down further, the weakness becomes even more visible in specific areas. In zip code 07202, the median sale price fell 6.9% year over year, while the median price per square foot declined by 22.3%. That isn't a small fluctuation. It's a clear sign that pricing power is eroding in certain parts of the city. This is where the pressure in Elizabeth really forms. A market like this depends heavily on buyers believing the trade-offs are still worth it. The location is supposed to offset the downsides: traffic congestion, industrial surroundings, and everyday congestion in general. But once uneven performance across neighborhoods becomes easier to see, buyers stop viewing the city as a single consistent value. Instead, they start analyzing it in fragments, by neighborhood, by street, by level of compromise. And when that happens, sellers lose the ability to rely on broad demand to carry their pricing. They have to defend each listing much more carefully. That's how a market like Elizabeth begins to soften in real time, not through a sudden collapse, but through a gradual loss of cohesion in how the city's value is perceived. The city still has activity. It still serves a clear practical role in the region. But once buyers stop believing that utility alone guarantees stability, the balance of leverage starts to shift quickly. And in 2026, that shift is becoming increasingly visible. Number 8. Manasquan still represents one of the most polished versions of the Jersey Shore experience. It carries that classic small-town coastal charm, a walkable downtown, and the kind of beach town atmosphere that people naturally romanticize. It has never needed to compete on affordability because that was never really the appeal. Buyers weren't simply purchasing property here. They were buying into a curated version of shore living that feels refined, safe, and worth paying a premium for. That's exactly why the current shift in 2026 is so important. Shore markets that are heavily driven by emotion tend to hold up well until buyers stop making emotional decisions. In February 2026, Redfin data shows Manasquan home prices up 22.8% year over year, with a median sale price around $1.385 million. On the surface, that still looks extremely strong. However, there's a noticeable change in momentum beneath those numbers. Homes are now taking about 41 days to sell, compared to just 26 days the previous year. In a high-end coastal market, that kind of slowdown carries more weight than it would in an average suburban area. It suggests that while demand for the location is still there, buyers are becoming more deliberate and less willing to stretch aggressively just to secure a property. And that's where the first real pressure starts to show. Markets like this rely heavily on urgency, the idea that if a buyer hesitates, someone else will immediately step in and take the same coastal dream off the table. But once that urgency begins to fade, pricing becomes more fragile than it initially appears. At that point, buyers shift away from emotion and start doing much more careful evaluation. Insurance costs become more important. Flood risk enters the conversation more seriously. Ongoing maintenance starts to weigh heavier. Seasonal fluctuations and carrying costs begin to factor into decisions in a much bigger way. The lifestyle premium has to compete directly with the financial reality of maintaining it. That pressure intensifies in a town like Manasquan because so much of its value depends on scarcity feeling competitive and fast-moving. Once that urgency fades, buyers begin comparing it not just within the town itself, but against every other shore market where taxes, insurance, and upkeep might feel more manageable. A home that once felt like a rare coastal opportunity starts to feel more like something to negotiate. Listings that previously would have sparked immediate competition now sit long enough for hesitation and doubt to creep in. That's what creates vulnerability in Manasquan in 2026. The town can still look stunning, and the shore narrative still holds emotional weight. But once that emotional pull stops carrying the entire decision, the market is forced to rely more heavily on raw numbers. And in premium coastal areas, that's often where the first meaningful cracks begin to appear. Number 7. Paterson is where the market starts to look healthier in the headline data than it actually feels on the ground. This is often viewed as a value-driven entry point within North Jersey. Dense housing, older construction, strong urban energy, and pricing that typically sits below many surrounding markets. For years, that made Paterson relatively easy to justify, especially when buyers equated cheaper than nearby areas, with lower risk. But in 2026, the reality is becoming more complicated as the market is moving at a pace that feels heavier and less efficient than what you'd expect from a stable environment. According to Redfin, Paterson home prices were up about 20.2% year over year in February 2026, with a median sale price near $645,000. On paper, that still looks like strong appreciation. However, the underlying activity tells a different story. Homes are now taking around 82 days to sell, compared to 61 days the year before, and total sales have slipped from 37 to 30. That combination makes the price growth feel less meaningful than it appears at first glance. A market can post strong year-over-year gains and still become noticeably harder to transact in. That distinction matters because buyers in Paterson have always had to weigh pricing against compromises: property condition, neighborhood variability, building upkeep, and street-by-street differences. Those trade-offs become much more difficult to accept when homes stop moving quickly. Once listings sit longer, buyers no longer assume they need to act fast. Instead, they gain time to question whether the deal is actually worth it. A property that once felt like a clear North Jersey value opportunity starts to feel more uncertain, even risky. And that pressure tends to build more quickly in a city like Paterson because its appeal has always been based on comparison rather than image. Buyers justified the compromises largely because surrounding markets were even more expensive. But when days on market stretch out like this, that comparison dynamic begins to flip. Instead of focusing on what they're saving, buyers start questioning whether the discount is enough to justify the condition, the location, or the building itself. They begin wondering if a better opportunity might appear just a few blocks away, or if waiting a little longer could unlock something stronger. That's the point where hesitation starts turning into leverage. And that's how a market like Paterson begins to soften, not through a dramatic break, but through a steady increase in doubt. In 2026, that shift is becoming increasingly hard to ignore. Number 6. Camden is where the weakness stops being something you can easily talk away and starts becoming much harder to ignore or reinterpret. For years, this city has sat in the middle of redevelopment narratives, institutional presence, and investor speculation. That combination helped build a long-running belief that housing still had upside potential, especially given how low entry prices were compared to many surrounding areas. For a while, buyers could convince themselves they were getting in early, positioning ahead of a broader recovery that would eventually show up in the numbers. But in 2026, the data is telling a much colder story than the optimism surrounding it. In February 2026, Camden home prices were down about 7.3% year over year, with a median sale price near $140,000. At the same time, homes are now taking roughly 52 days to sell, up sharply from 29 days the previous year. Total sales have also slipped slightly, moving from 34 to 33. When you zoom into zip code 08104, the decline becomes even more severe. Median sale prices dropped around 26% year over year, while median price per square foot fell by about 27%. That isn't just mild softness. It's a clear erosion in both value and speed that buyers can feel in real time. That matters because Camden's housing narrative has always leaned heavily on affordability as the primary selling point. This was never a market protected by prestige or strong brand appeal. The entire pitch was based on low entry cost and the idea that affordability itself represented opportunity. But when prices are falling and homes are taking longer to move, affordability stops feeling like a safety net. Instead, it starts to feel like a signal that there may still be downward room in the market. Buyers no longer automatically interpret cheap as good deal. They begin to wonder whether it actually means further risk ahead. That's what makes Camden particularly sensitive in this cycle. The city can still produce isolated success stories, an upgraded corridor, a renovated home, a block that has clearly improved over time, but those pockets of progress can also make the broader weakness easier to underestimate. Buyers see those scattered improvements and assume the overall market must still be trending upward. Meanwhile, the broader sales data is sending a much more cautious message. The issue in Camden isn't just perception, it's confidence. And in 2026, that confidence is clearly weakening. Even if one street still looks promising or one property still sells well, the wider market tone is shifting in the opposite direction. And when a city built on affordability starts to feel uncertain instead of simply cheap, confidence tends to drain out faster than most people expect. Number 5. Trenton ranks this high because the practical foundation that used to support its housing narrative is no longer holding up the way it once did. As the state capital, with rail connections, geographic positioning, and institutional importance, it has always carried a baseline level of relevance that made buyers assume the market would at least remain stable. That sense of built-in logic is exactly what made Trenton feel more reliable than many of New Jersey's more visibly unstable housing markets. It was never marketed as exciting or upscale. It was supposed to make sense on paper. And when a market that's built on sense starts to weaken, the discomfort often feels sharper than in places where volatility is already expected. In February 2026, Trenton home prices were down about 9.78% year over year, with a median sale price around $27,500. At the same time, homes are now taking roughly 73 days to sell, slightly slower than the 67 days recorded the previous year, and total sales have slipped from 33 to 30. Taken together, that shows a market that is losing pricing power, moving more slowly, and completing fewer transactions at the same time. That matters because Trenton's entire appeal has historically been built around straightforward logic: low prices, functional location, reasonable commuting access, and an entry point that feels attainable. But when prices begin to fall and listing times continue to stretch, that simple case starts to weaken. Buyers stop viewing Trenton as a smart compromise and begin to wonder whether it requires a deeper discount before it truly makes sense. The homes may still be relatively affordable, and the city may still offer connectivity, but the confidence behind purchasing decisions is no longer automatic. That shift hits harder in a place like Trenton because buyers were never paying for hype. They were paying for rationality. The belief was that even if the city wasn't perfect, the numbers still worked in its favor. Once that underlying logic starts to break down, every existing drawback becomes more pronounced. Older housing stock starts to feel riskier. Maintenance and repair costs feel harder to justify. Listings that once seemed like straightforward value plays begin to look like decisions that require much more caution. That's how Trenton begins to crack in real time, not because buyers misunderstand the location, but because they start questioning whether location alone is still enough to justify the price. And in a city where practicality was the core selling point, that shift in confidence becomes difficult to ignore. Number 4. New Brunswick used to be seen as one of the more dependable housing bets in New Jersey. It carried multiple strong identities at once, which made it feel more resilient than many nearby markets. As a college town, a healthcare center, and a commuter hub connected by rail, it had several different demand drivers that were supposed to balance each other out if one weakened. Because of that mix, buyers, landlords, and investors often assumed New Brunswick would remain more stable than surrounding cities, even during slower periods. It felt like a market with built-in backup support. But in 2026, that layered structure is starting to show signs of strain. Citywide data from Redfin shows New Brunswick home prices rising only about 1.2% year over year in February 2026, with a median sale price around $555,500. On the surface, that still looks relatively steady. However, the underlying activity tells a different story. Homes are now taking about 87 days to sell, up from 65 days the year before, and the number of homes sold has dropped sharply from 21 to 10. When you look at zip code 08902, the weakness becomes even more obvious. Prices there are down about 9.36% year over year. Homes are taking around 83 days to sell, and total sales have fallen significantly from 87 to 50. That level of volume loss can change the tone of a market very quickly. And that's what makes New Brunswick more fragile than it initially appears. The institutions are still in place, the university, the hospital system, the train access, the commuter flow, but the market no longer feels like it has the same overlapping cushion it once relied on. What used to stabilize the city was the diversity of its buyer base. Students, healthcare workers, commuters, young professionals, and small investors all created different layers of demand that reinforced each other. But once all of those groups become more cautious at the same time, that overlap starts to disappear. And when that happens, the sense of protection in the market weakens quickly. A condo near transit no longer feels automatically safe. A rental near campus is no longer an easy hold. A home close to the medical corridor no longer guarantees steady demand the way it once did. And as buyers begin to recognize that even New Brunswick can lose momentum this quickly, the perception of safety shifts. Instead of treating it as a reliable, set-and-forget market, they start viewing it as something that requires more precise pricing, more patience, and far more justification than before. In 2026, that erosion of confidence is becoming increasingly visible. Number 3. Newark has long been positioned as New Jersey's flagship comeback story. It's a city defined by transit access, downtown redevelopment, corporate presence, airport and port infrastructure, loft conversions, and spillover growth from nearby urban centers. For years, it's been framed as a place that still offered upside potential, while already being developed enough to feel relatively safe. That combination is exactly why the early signs of weakness here matter so much. Newark isn't a quiet or secondary market. When conditions shift here, it sends signals that ripple across the broader state. In February 2026, Redfin data shows Newark home prices up about 9.6% year over year, with a median sale price around $625,000. On the surface, that still suggests momentum. But the underlying activity tells a more cautious story. Homes are now taking roughly 72 days to sell, and total sales have slipped slightly from 80 to 77. Those numbers may not look extreme at first glance, but they matter more when you consider what Newark is fundamentally supposed to represent: forward movement and ongoing demand. Once that sense of momentum starts to slow, even modestly, the narrative itself begins to get tested. And that's where Newark becomes especially important in this list. This is a market that has been built as much on expectation as on raw data. Buyers weren't simply purchasing property. They were buying into a story of continued upward trajectory. The idea was that Newark was still in progress, that redevelopment would keep expanding, that neighborhoods would keep improving, and that getting in early would ultimately look like a smart decision in hindsight. But when homes start sitting longer on the market, buyers begin to reinterpret that story. The narrative doesn't disappear, but it loses some of its power to justify pricing on its own. That's the key shift here. Newark still has strong branding, and it still benefits from transit and location advantages, but buyers are no longer relying on the story alone. They're paying closer attention to timing, neighborhood-level differences, pricing realism, and negotiation space. Once that happens, the market stops feeling like an obvious upward opportunity and starts feeling more conditional, something where every purchase needs to be carefully justified rather than assumed to be a win. And in a city like Newark, that change carries real significance. When confidence in the comeback narrative starts to fade even slightly, each listing has to work harder to attract demand. Location alone carries less weight. The story alone carries less influence. Sellers can no longer assume that future demand will automatically validate today's price. That's why Newark ranks this high. It's not that the city lacks strengths. It's that those strengths are no longer strong enough on their own to keep sentiment fully stable. And once buyers begin questioning the pace of the comeback, the shift in tone becomes much harder to ignore. Number 2, Hoboken ranks. At number 2 because the type of weakness showing up here carries a very different psychological impact compared to the other cities on this list. This is not a budget or entry-level market trying to find stability. It's one of the most established high-cost urban housing markets in New Jersey. With its waterfront setting, direct Manhattan access, dense restaurant and nightlife corridors, mix of condos and older walk-up buildings, and long-standing reputation as a polished alternative to New York City living, Hoboken has always been positioned as a premium lifestyle market. Buyers in this city were never just paying for physical space. They were paying for convenience, identity, and the expectation that demand would remain strong enough to justify stretching financially. But in February 2026, Redfin data shows Hoboken home prices down about 13.7% year over year, with a median sale price around $757,500. At the same time, homes are now taking roughly 43 days to sell, up from 29 days the previous year. In a high-priced, confidence-driven market like this, that kind of slowdown is significant. When prices fall and listings take noticeably longer to move, the sense of certainty that once defined the city begins to fade quickly. And that matters because Hoboken has always depended on urgency as much as location. The entire market dynamic was built on the idea that if you hesitated, someone else would immediately take the exact apartment, the same block, or the same version of the lifestyle you were considering. Once that urgency starts to weaken, the premium attached to the city comes under pressure. Buyers begin looking far more closely at HOA fees, property taxes, insurance costs, maintenance expenses, and the true monthly burden of ownership. What once felt like a justified lifestyle trade-off starts to feel more like an expensive financial calculation. That's what makes Hoboken such a critical signal in this cycle. When a market at this price level starts to soften, buyers stop assuming that the location alone guarantees strong value retention. Monthly carrying costs feel heavier. Taxes feel more aggressive. Mortgage payments feel less comfortable when appreciation is no longer reinforcing confidence. A property that once felt like a smart compromise between New Jersey and Manhattan, living begins to feel like a much more expensive decision that requires serious justification. And that shift doesn't require a full market collapse. It only requires enough buyers deciding that the old pricing no longer aligns with current conditions. In a premium urban market, that kind of mindset change is powerful. Sellers can no longer rely on the address alone to carry value. Buyers, in turn, stop rushing because they believe patience might finally be rewarded. And once that behavior takes hold in Hoboken, the signal extends well beyond the local market itself. Number 1, Jersey City takes the top spot because it's where the housing market's underlying cracks are hardest to ignore. Not because the city is collapsing, but because the long-standing assumption of automatic stability is starting to break down. For years, Jersey City was built around a very compelling narrative. It offered New York adjacency, skyline views, fast transit access, and modern housing stock, all at prices that were still lower than Manhattan. That combination fueled enormous demand, but it also fueled a strong sense of confidence among buyers who believed Jersey City was still the smart alternative. By 2026, however, that narrative is starting to show strain. Citywide data from Redfin shows Jersey City home prices up about 20.5% year over year in February 2026, with a median sale price around $800,000. On the surface, that still looks like strong appreciation. But the transaction data tells a more cautious story. Homes are now taking roughly 72 days to sell, and total sales have slipped from 132 to 125. That combination suggests the market is no longer moving with the same ease or confidence it once did. In a high-cost urban environment, longer selling times often signal that demand is becoming more selective, even if prices haven't fully reflected it yet. And that's why Jersey City sits at number 1. This isn't just a housing market, it's a story market. It sells proximity to New York, lifestyle convenience, momentum, and the idea of relative value compared to Manhattan. When that story begins to weaken, the effects ripple far beyond individual buildings or neighborhoods. The entire market starts to be reassessed through a more cautious lens. What once felt like an obvious, best compromise begins to feel more sensitive to interest rates, carrying costs, competition, and buyer hesitation. That matters even more because of the type of buyer Jersey City attracts. Many are paying for speed, access, lifestyle, and the expectation that demand will remain strong enough to support long-term value. But when homes start sitting longer on the market, that assumption begins to erode. Buyers respond by slowing down, comparing more aggressively, and scrutinizing monthly ownership costs more carefully. They begin asking whether the premium still makes sense, especially if future sellers may become more flexible. That shift quickly turns hesitation into negotiating power. This isn't a collapse, but it is the early shape of one. The skyline still appeals. The location still matters. The branding still holds weight. But once buyers stop feeling pressure to act quickly, the emotional foundation of the market changes. And in a city like Jersey City, that shift carries more impact than almost anywhere else in New Jersey.